Good morning. Imagine for a moment that you wake up today and every bank in the world is gone. It sounds strange at first, doesn't it? Maybe this is actually great for all of us. Or maybe we're standing right on the edge of a massive disaster. Let's take a look at this scenario. You wake up on payday, open your banking app with that little rush of excitement, and bam, nothing. Look, I'm not saying your balance is zero. There isn't even an app anymore. Every bank has literally disappeared. The branch in your neighborhood is completely empty. ATM screens are dark, cards are being declined, and suddenly, the salary you waited all month to receive is impossible to access. In a situation like this, your first instinct would probably be to think about yourself. I'll be honest, I would do exactly the same. As someone who can barely function before having coffee in the morning, my first panic questions would be simple. Can I get breakfast? How am I going to pay the rent? Is my money still mine? You know that famous line from legendary boxer Mike Tyson? Everyone has a plan until they get punched in the mouth. Waking up one morning to find that the entire system had been unplugged would feel like exactly that kind of punch. These questions may sound simple, but banks form the invisible foundation beneath so many parts of our daily lives that removing them would do much more than interrupt the flow of money. It would tear apart the enormous system that records who owns money, moves it between people, and takes savings and turns them into loans for someone else. Most of us think of a bank as a secure vault. But that isn't quite how it works. Banks do not keep every dollar you deposit locked inside their vaults. They hold only a small reserve, convert the rest into assets, and lend money to other people and businesses. In other words, your money may be circulating through the economy as someone else's mortgage. That is why, if every bank disappeared at the same time, it would be mathematically impossible for everyone to get all their money back immediately. The first problem would be access. Within the first few minutes, card payments connected to bank accounts would begin to collapse. Debit cards would become ordinary pieces of plastic. Most credit cards would stop working too, because the institutions responsible for authorizing transactions would no longer exist. Online transfers would freeze. Automatic payments for rent, electricity, insurance, and those streaming subscriptions we all love would no longer go through. At that point, cash would suddenly become incredibly powerful. Anyone holding banknotes could still use them to pay for things. But even if converting digital money into cash were possible, there would not be enough physical currency in the world for everyone to withdraw their digital balances at the same time. Modern economies move enormous amounts of money electronically because printing, transporting, protecting, and counting the same value in paper currency would be both painfully slow and incredibly expensive. The Federal Reserve describes the payment system as a network supporting everything from receiving a paycheck to buying groceries with a debit card. Banks do not make up the entire network, but they are essential access points. They identify customers, maintain accounts, verify balances, and connect transactions to the wider payment system. If those access points suddenly vanished, everyday shopping would take a devastating hit. By lunchtime, supermarkets, restaurants, and gas stations would face a very strange choice. They could accept cash only, offer customers informal credit, or stop selling altogether. A customer might have $10,000 in an account that no longer exists, but only $12 in their wallet. On paper, that person is financially comfortable. At the checkout, however, they cannot even pay for a cart full of groceries. Picture yourself standing there with milk, bread, and your favorite cereal, while the payment terminal keeps flashing red. You know you earned that money. The cashier probably believes you have it, but neither of you can prove it or transfer it. That tiny moment reveals what banking really sells us. Banks sell us reliable records. Before we continue, decide what you would do first. Would you look for cash, call your employer, or try to trade something valuable? Tell me in the comments right now. Your decision will reveal which part of the banking system you depend on most, and I'll meet you in the replies. Within the first day, employers would struggle to pay their workers. Payroll companies could still calculate everyone's wages, but bank accounts are normally where that money is delivered. Companies could make promises on paper, hand out limited amounts of cash, or record what they owed their employees in a ledger. But none of those options would work smoothly across millions of workplaces. Online shopping would collapse as well. Giant marketplaces like Amazon could continue displaying products, but buyers and sellers would lose the payment methods they normally rely on. Digital wallets connected to bank accounts would face the same problem. No matter how polished an app may look, It cannot replace the institution holding and settling the funds behind the scenes. The truth is, the digital interfaces we love are little more than storefronts for the banks behind them. International trade would feel the disruption immediately. An importer purchasing machine parts from another country rarely sends a suitcase full of cash across the ocean. Banks verify instructions, exchange currencies, finance shipments, and give sellers confidence that payment will arrive after their goods cross the ocean. Without that structure, cargo would sit at ports and deliveries would grind to a halt, while buyers and suppliers argued over how to exchange value safely. Just imagine the chaos in foreign exchange markets. Banks are major players connecting national financial systems. Even companies with warehouses packed with inventory might stop shipping because they could not verify payment. The banking crisis would spread into factories and stores that appear to have nothing to do with finance. A transfer that fails in one country could delay parts in another, slow production in a third, and prevent wages from being paid somewhere else entirely. The modern economy does not move only products across borders. It moves promises of payment alongside them. Some independent digital currencies might continue moving across their own networks. Their prices could soar as people search for alternatives. But volatility, limited acceptance, lost passwords, transaction capacity, and the need to convert them into everyday goods would remain serious obstacles. After all, a currency serves a purpose only if the person selling food, medicine, or electricity is both willing and able to accept it. The second major problem would be deciding what had happened to the money that already existed. As of September 2025, the Federal Deposit Insurance Corporation estimated that it insured approximately $10.66 trillion in domestic deposits across thousands of American institutions. Those deposits represent household savings, business cash, payroll funds, and emergency reserves. If the banks disappeared, but government records survived, authorities could try to reconstruct those balances and guarantee access to the money. This rescue operation would become one of the largest administrative projects in history. Authorities would need account databases, identity verification, transaction histories, fraud checks, and an entirely new place to hold the reconstructed balances. If the data disappeared along with the banks, customers might have to submit bank statements, tax documents, receipts, and screenshots as evidence. And that is exactly when fraud would enter the picture. People would claim balances they never had. Criminals would create fake records. Families would discover that passwords and account details were known only by a relative they could no longer reach. Companies with complex accounts across several countries would face an extraordinary legal mess involving ownership and authority. Governments would probably freeze many financial obligations temporarily. Rent payments, loan installments, tax deadlines, and utility bills could be paused because neither side would be able to settle normally. This might protect households for a few days, but it would also deprive landlords, lenders, governments, and service providers of the income they expected. Remember, every payment you make becomes someone else's income. By the second day, the crisis would spread into credit. A bakery that needs flour today would normally use a revolving line of credit and repay it after customers bought the bread. A farmer might borrow before planting and earn revenue after the harvest. A family can buy a home and spread the repayments across decades. Banks connect today's needs with tomorrow's earnings. Without banks, companies could spend only the cash they already had. Businesses with large reserves would survive, but small companies operating from week to week would cut purchases and working hours. Construction projects would stop. Home sales would freeze because very few buyers could pay the entire price immediately. This is the point where the crisis would jump from payments into production. A business might survive one day without card sales, but it cannot last long without paying workers, buying inventory, or financing equipment. And interest rates would not simply fall to zero because the banks were gone. Informal lenders and wealthy investors would demand extremely high returns because they would be taking risks without the credit histories and collateral systems they normally rely on. Borrowing could become far more expensive at the exact moment people needed it most. History has already given us smaller glimpses of this fear. In the spring of 2023, several banks in the United States failed after rapid deposit outflows. Silicon Valley Bank lost tens of billions of dollars in deposits during an extraordinary panic. Those events affected only a small part of the banking system. Even so, governments moved very quickly because they understood one thing perfectly. Trust travels much faster than cash. The lesson is not that every bank failure will destroy the economy. Deposit insurance and resolution systems exist to prevent an individual failure from becoming a widespread panic. The real lesson is that banking depends on a shared belief that today's records will still be valid tomorrow. If every bank disappeared, that belief would have to move somewhere else. During the first week, central banks and governments would probably create emergency public accounts. Citizens could receive temporary digital wallets verified through tax or identity systems. Essential payments could be given priority. Employers might send wages through a government-backed platform. Cash distribution centers could open in post offices, schools, or municipal buildings. Major technology companies would immediately try to fill this enormous gap by offering alternatives. They already have huge customer networks, data centers, identity tools, and payment experience. Retail platforms could hold balances for buyers and sellers. Telecommunications companies could expand mobile money services. Supermarkets might issue local payment credits. These systems could restore transactions, but they would raise a completely new question. Who should be trusted with the financial life of an entire population? A technology giant might make payments incredibly easy while collecting detailed information about everything you buy. A government system might be stable but slow and politically controversial. A retail company might handle everyday spending but struggle with mortgages and business loans. Replacing a banking app would be child's play compared with replacing all the complex functions hidden behind it. Local communities would develop their own solutions. Businesses could keep tabs for regular customers. Employers might distribute vouchers accepted at nearby stores. Neighbors could lend directly to one another. Barter might return for certain transactions. A mechanic could repair a farmer's truck in exchange for food. This sounds flexible and deeply human, but informal trust does not spread equally. People with strong connections, valuable skills, or property would have options. A new worker in an unfamiliar city might have none. Banking can feel cold and impersonal, but standardized accounts allow strangers to transact without knowing each other personally. Speaking for myself, I rarely think about any of this when I tap my card to buy my morning coffee. The payment feels so seamless that money seems almost weightless. Without banks, however, every small purchase could require a long conversation about trust, identity, timing, and repayment. That might sound fascinating for a single cup of coffee, but it would be incredibly exhausting for an entire economy. By the end of the first month, the winners and losers would become clear. People holding cash, precious metals, widely accepted digital assets, or useful goods would gain enormous flexibility. Companies with no debt and huge cash reserves could buy distressed assets at very low prices. Payment technology firms could become some of the most valuable organizations in the world. The greatest losses would fall on people whose wealth existed mainly in bank deposits and whose records were difficult to reconstruct. Small firms dependent on credit would face a brutal struggle. First-time homebuyers would be pushed out of the market entirely. Workers living paycheck to paycheck would face immediate and severe poverty despite having done nothing wrong. It isn't fair, I know, but unfortunately that is the nature of financial crises. Existing debts would become a legal battlefield. If a bank disappeared, would your mortgage debt disappear with it? Normally, a loan is an asset that can be transferred to a new owner. Governments would probably preserve valid debts while moving them to new public institutions or financial organizations. Otherwise, borrowers would receive enormous windfall gains while pension funds, insurers, and savers connected to those assets suffered terrible losses. That decision would certainly not be popular. A family might ask why it should continue repaying a mortgage to a bank that no longer exists. The answer is that the money financing that loan may ultimately come from another family's savings or retirement plan. Financial claims form interconnected chains. Breaking one link redistributes wealth in ways that are extremely difficult to see. Within a few months, entirely new institutions would emerge. Some would begin as payment providers, while others might start as credit unions, public utilities, technology platforms, or merchant networks. They would hire analysts to evaluate borrowers. They would protect customer balances, maintain records, detect fraud, and connect savers with people who needed capital. They might make grand promises that they would be completely different from banks. Then customers would begin demanding safe deposits. Businesses would ask for loans. Regulators would require reserves and audits. Payment networks would need settlement rules. These new institutions would charge fees or earn interest to cover their costs. And slowly, these new organizations would become banks again in every way except their names. None of this means that today's banking system is perfect. Banks can fail, misjudge risk, exclude customers, charge confusing fees, and grow so dangerously large that governments feel forced to rescue them. A world rebuilding finance could design stronger public options, clearer consumer protections, faster payments, and better access. But eliminating banks would not eliminate the economic needs that created them. People would still need a secure record of their savings. Strangers would still need reliable payments when transacting with one another. Businesses would still need capital before they could earn revenue. Families would still need to spread the cost of a home across many years. The deepest lesson is this: money is not simply banknotes, coins, or numbers on a screen. Money is a network of promises. A bank account is a promise that your balance will be recognized by the system and can be transferred somewhere else. A loan is a promise that future income will repay today's spending. Deposit insurance is a promise that the failure of one institution will not erase a family's entire savings. Now return to that payday morning. Your phone is still working, but your bank is gone. The number you expected to see has evaporated. You are furious because that money represents hours of your life spent working. Eventually, emergency systems might restore that number. New institutions could rebuild payments. Credit could slowly return.